Welcome to Tax Takes. My name is Catherine Koukoulas. In this video, we will review the income tax rules applicable to partnerships. As you watch this video, I recommend that you have your learning materials open so that you can highlight key sections and add your own note. To correctly answer a question that involves a partnership, you need to remember the fundamental income tax principles that are covered in Unit 1 of your learning materials, and then link those fundamentals to the partnership-specific rules that are covered in Unit 9 of your learning materials. The first fundamental income tax principle is that a resident taxpayer is taxable in Australia on their worldwide income, while a non-resident taxpayer is only taxable in Australia on their Australian-sourced income. As the net income from the partnership flows and is assessed to the partners, for a partnership, this principle is applied at the partner level. That is, a partner who is resident for an income year will return their share of the entire net income of the partnership, which is the income from all sources, under Section 92, subsection 1, little a. For a partner that is a non-resident for the income year, they will return their share of so much of the net income that is attributable to Australian sources only, under Section 92, subsection 1, little b. A second fundamental income tax principle is that assessable income includes ordinary and statutory income, but excludes exempt income and non-assessable non-exempt income, otherwise known as NAIN income. The calculation of net income for a partnership is done on the assumption that the partnership is a resident. Therefore, income and expenditure from worldwide sources is included in calculating net income. Specifically, under Section 90, net income or loss of the partnership equals assessable income less allowable deductions, except for prior year losses and personal superannuation contributions, as these are deducted at the partner level. Therefore, in applying the second principle, ordinary and statutory income derived by a partnership is included in net income under Section 6.5, and non-assessable non-exempt income is excluded. An important exception is that capital gains and losses arising in relation to partnership CGT assets are ignored and included as assessable and deductible at the partner level based on the partner's fractional interest in assets under Section 106-5. For resident partners, this includes capital gains and losses from worldwide assets held by the partnership. For non-resident partners, only capital gains or losses arising from taxable Australian property are included. We will consider an example on this point later in this video. The third fundamental income tax principle is that an allowable deduction includes general and specific deductions, and a general deduction includes amounts incurred in carrying on a business or in deriving assessable income, but excludes amounts incurred in deriving exempt or NAIN income and excludes private expenditure. However, for a partnership, as outlined previously, allowable deductions incurred by the partnership are deducted from assessable income in calculating net income of the partnership. The exceptions are prior year loss deductions under Division 36 and personal superannuation contributions under Section 290-150, which are taken directly to partners' personal income tax returns. Further, partner salaries and interest on partner capital accounts are not deductible under Section 8.1 to the partnership, as these are considered to be an allocation of partnership profits or drawings under the partnership agreement, which are assessable or non-assessable income respectively to the partners. This is because the partnership is not a separate legal entity and partners are not considered to be employees. Therefore, any income distributions or benefits received by partners are received as a consequence of their interest in the partnership and as agreed within the partnership agreement. We will consider these by way of an example later on in the video. Once the partnership net income is calculated, it is allocated to the partners based on their individual share in the partnership. For a common law partnership that is carrying on business, a partner's share of net income is determined based on the terms agreed by the partners in a formal, written or oral agreement. For a tax law partnership, the partners agree to share income jointly or based on their ownership percentages in the underlying property. And the fourth and final fundamental tax principle is that tax offsets reduce income tax payable. They are not a deduction. They are applied after income tax payable has been calculated. For a partnership, as tax payable is calculated at the partner level, Each partner is entitled to claim tax offsets, including franking and foreign income tax offsets, based on their share of franked dividends and foreign income included in partnership net income. As was considered in Unit 1, tax offsets reduce tax payable, but for a partnership at the partner level. It should be noted that non-resident partners are not entitled to claim franking offsets, as franked dividends received by non-residents are named under Section 128D and subject to a nil withholding tax under Section 128B, subsection 3GA. Foreign income is not included in assessable income for a non-resident partner, as under Section 6.5, a non-resident is only assessable on income from Australian sources. So let's do an example to check your understanding of partnerships. In example 1, Smith and Jones are equal partners in the SJ Partnership, which carries on a business in Australia. SJ Partnership has an accounting profit of $700,000 for the current year. Net partnership income is allocated to partners equally after entitlements to partner salaries. Included in accounting profit are the following transactions. 1. Salaries paid to Smith and Jones totaling $170,000. 2. Interest paid on the partner capital accounts totaling $2,000. 3. Profit on disposal of the building totaling $150,000. And 4. School fees paid totaling $7,000 for Smith's children and $5,000 for Terry's children, who is a project manager and employee of the partnership. The required task asks you to calculate the net profit or loss of the partnership by preparing a reconciliation from accounting profit to the net partnership income or loss. In addition, you are required to calculate the allocation of partnership net income for each partner. So let's consider transaction 1. Can SJ Partnership claim an income tax deduction for salaries paid to Smith and Jones? The correct answer is no. A partner is not an employee, as a partnership is not a separate legal entity as per the principle in Ellis and Joseph Ellis & Co. A partner salary is therefore a priority distribution of partnership profit to the partners and not a true salary, and is not deductible to the SJ Partnership under Section 8.1. So now that you know that, what impact would Transaction 1 have on SJ Partnership's reconciliation from accounting profit to net partnership income or loss? The correct answer is an add-back adjustment of $170,000 in the partnership's net income reconciliation for tax. This is because the amount is expensed in calculating the accounting profit for the partnership. This would increase the net income which is distributed and accessible to the partners under Section 92. So let's consider Transaction 2. Can SJ Partnership claim an income tax deduction for the interest paid on the partner capital accounts? The correct answer is no. Interest paid on the partner capital accounts is non-deductible under Section 8.1. As was the case with salaries paid to partners, interest paid on partner capital accounts is treated as an allocation of profits accessible at the partner level under Section 92. So now that you know, what impact would Transaction 2 have on SJ Partnership's reconciliation from accounting profit to net partnership income or loss? The correct answer is an add-back adjustment of $2,000 in the partnership's net income reconciliation for tax. This is because the interest has been expensed in the accounting profit of the partnership. This would increase the net income which is distributed and accessible to the partners under Section 92. So let's consider Transaction 3. Is SJ Partnership accessible on the net capital gain on disposal of the partnership building? The correct answer is no. A capital gain or loss for CGT purposes is ignored at the partnership level as the fractional or proportional interest approach is taken. Each partner has a proportionate interest in each and every asset of the partnership under Section 106-5 and Section 108-5, subsection 2c, and calculates their individual capital gain or loss on disposal of their interest in the partnership or the individual asset. As noted on slide 2, a resident partner includes capital gains and losses arising in relation to the disposal of worldwide assets held by the partnership, whereas a non-resident partner includes only capital gains and losses arising in relation to the disposal of taxable Australian property held by the partnership, which is defined under Section 855-10. So now that you know that, What impact would Transaction 3 have on SJ Partnerships reconciliation from accounting profit to net partnership income or loss? The correct answer is a subtraction adjustment of $150,000 in the partnership's net income reconciliation for tax. This is because the profit on disposal of the building has been included in the partnership's accounting profit. This would decrease the net income which is distributed and accessible to the partners under Section 92. However, the capital gain will then be included as assessable income at the partner level based on their 50% share of the capital gain, calculated as $400,000 less $290,000, which is the cost base, which gives a gross capital gain of $110,000. The individual partner share of the gross capital gain would be $55,000 before applying the CGT 50% discount. Therefore, the net capital gain after CGT discount would be $27,500. So let's consider Transaction 4. Can SJ Partnership claim an income tax deduction for the private expenses paid for Smith and Terry? The correct answer for the school fees paid on behalf of Smith totalling $7,000 is no. Private expenses are not subject to FBT as partners are not employees of the partnership. Further, as the expenses are private expenses, school fees for Smith will not be deductible under Section 8.1 to the partnership. However, the correct answer for the school fees paid on behalf of Terry totalling $5,000 is yes. As Terry is an employee, the payment of the school fees will give rise to a fringe benefit for the SJ Partnership, which is subject to FBT and payable by the partnership. The school fees will also be deductible under Section 8.1 as employee remuneration expenses. So now that you know that, what impact would Transaction 4 have on SJ's partnership reconciliation from accounting profit to net partnership income or loss? The correct answer is an add-back adjustment of $7,000 in the partnership's net income reconciliation for tax. This is because the school fees paid on behalf of Smith have been expensed in the partnership's accounting profit. This would increase the net income which is distributed and accessible to the partners under Section 92. The required task asks you to prepare a reconciliation. The net partnership income under Section 90 equals $729,000 and is calculated as considered in the previous slides by adding back to the partnership accounting profit of $700,000, the non-deductible partner salaries of $170,000, the non-deductible interest paid on the partner capital accounts of $2,000, and the non-deductible private expenses for partner Smith totaling $7,000. The profit on disposal of the building is subtracted, totaling $150,000 and is assessed at the partner level as previously considered under Section 106-5. The next step after calculating the net income of the partnership is to calculate each partner's share of the partnership net profit, which is assessable under Section 92. As outlined in the scenario, based on the partnership agreement, each partner's individual share of partnership net income is determined after adjusting for partner salaries, which are priority payments. The adjusted net income is then allocated to each partner based on their individual share in the SJ partnership, which is 50%. Therefore, the allocation is calculated as total net income of $729,000 less total salaries paid to the partners, which equals $559,000. This in turn is multiplied by 50% to work out the individual share for each partner of $279,500. Good luck with your studies. I look forward to chatting with you again soon.